Hi, good afternoon, everybody, and welcome to the first of our Need to Know series. Today, my name is Misha Peters. I am the Director of Assurance here at the XRB, and I am joined by two of the Assurance team members, Sharon Walker and Tracy Crookston. We've got a jam-packed agenda, so we do want to make sure we get underway very promptly and on time to allow us time to get through all of the content. This session will be recorded, and both the slides and the recording will be made available on our website following today's session. The XRB recently undertook a stakeholder survey, and while we got a lot of positive feedback, we wanted to find out ways that we can improve the way that we engage. We understand that our stakeholders are looking for an increase in awareness raising and more support to implement the standards that we issue. And today is one way in which we are hoping to meet this need. So we do have a jam-packed agenda. We are really focused in on standards that are coming into effect in due course. So there is a big suite of standards that are effective from December 2022, and we want to make sure that all auditors and assurance practitioners are aware of what changes are being made, why these changes have been made, and where to get help to make sure that you're ready to implement this in time. We'll also give you an overview of some of the other recent approvals and then a sneak peek at some of the things that are open for comment and things that you can watch out for into next year. Without further ado, I will kick off with our suite of standards that have been issued. They are gazetted, they are in law, and they are effective from December 2022. The first of that is our quality management standards. Now, we have been undertaking a significant amount of promotional and awareness raising activity. These standards have been issued over a year ago. We've had presentations at the CAANZ conference. We've done LinkedIn promotional activity. We've run alerts, and we've got a lot of implementation guidance up on our website. But today is one more reminder that now is the time to act. With only 129 sleeps to go until the revised quality management standards are effective, if you have not yet started, I hate to say it, but you are probably already a little bit behind. Quality management is so important in enhancing trust and confidence in the audit. These revised standards require a shift in mindset and approach, moving from a reactive quality control to a proactive risk-based management approach. There is an increased focus on the tone from the top and requires an integrated, firm approach to managing quality. This really is not about a compliance exercise. These changes are meant to be scalable and tailor-made for your firm so that it results in a streamlined operation that improves quality and results in targeted actions appropriate for your firm. The key change is the introduction to a risk-based approach, hence the introduction of a risk assessment process. In order to achieve this focus on risk management, at a high level, the firm is required to first establish quality objectives and then identify and assess quality risks to those objectives. Once you've assessed the risks, then it's up to you and your firm to design and implement responses that address those quality risks. Now, the standard does help in that it does establish quality objectives for all firms, and it also has some prescriptive requirements for the responses, but the rest of the work needs to be done at a firm level. The final part of the risk assessment process is what I call rinse and repeat. So just like an audit, it's an iterative process. It's not a once and done approach. It will require a consistent approach to identifying risks and making sure that the firm is addressing those risks in all the engagements that they undertake. A quick reminder as to where these requirements will be found. Well, there's actually a number of places where the quality management requirements are found. There's 3 standards. The first and most important is PES 3, otherwise known as ISQM1 internationally, and that sets the requirements for quality management at the firm level. That's a revision to the old PES 3. There is a new standard, PES 4. Now that deals specifically with engagement quality reviews. So PES 3 sets the requirements as to when an engagement quality review needs to be undertaken, but PES 4 separates out the how and the why and the when, and how to document how that engagement quality review is undertaken. Then thirdly, there's ISA 220 revised. That deals with quality management at the audit engagement level, focused really on the responsibilities of the engagement partner. So the firm is responsible for designing, implementing, and operating its system of quality management, but there's some of those requirements that are being undertaken at the engagement level too. What's really important to appreciate is that quality management is an integral part of an audit and an integral part of the firm. So in changing the quality management requirements, actually there's been tweaks and changes to almost each and every single auditing and assurance standard. So we have gazetted the conforming amendments to all the auditing standards as well as to all of the assurance standards. If you go up onto our website now, you will see that all of these changes have been incorporated into each and every single one of the auditing standards. So for example, if you go to ISA 200 page, you will see a version of the standard that will be effective from December 2022. In terms of the timeline, just a quick reminder. Oh, sorry, I missed a slide. The focus of activity between now and December is for you and your firm to establish those quality objectives, and then identify and assess those risks and design and implement your responses. Also, you need to design and implement monitoring activities. Then from December 2022, you need to make sure that you are monitoring, your monitoring activity is underway, so that by December 2023, you can stand back and evaluate as a firm whether your system of quality management is working. Now we, as I mentioned, have a large amount of application material available on our website to assist you. So when you get these slides, you'll be able to click on this link and it will take you to our focus area. The IAASB has first-time implementation guides, fact sheets, a whole series of webinars on all the various aspects that have changed. And CAANZ has also recently issued a pro forma toolkit, which is really aimed at the small and medium-sized firms. So again, I encourage you to go and have a look at these resources. If you have not yet started, now is the time to get ready. The other key change that will come into effect from December relates to the Code of Ethics. Now, the Code of Ethics has had a number of changes from a huge number of projects. Not to name the least, there is changes resulting from objectivity, changes resulting from non-assurance services and fees. All of these changes come into effect at the same time for periods effective from December 2022. So on this one, if you go onto our website, let me just change the slide, hang on. If you go onto our website and click the link to PES 1, you will see a version of the Code of Ethics that is effective at 31 December 2021. You will also see a number of amending standards. So we have not yet pulled all of the changes into one version of PES 1. We are waiting on the final parts of the quality management amendments. So there's some final tweaks and small changes that we are hoping that the Auditing and Assurance Standards Board will approve and issue on at our meeting this week. So we hope to gazette these changes next week, and at the same time, we hope to include a version of PES 1 up on the website that includes all of these amendments in one place. But for now, you can see all 4 of these changes there, and that also helps you to understand which parts of the code are changing. I'm not going to talk in detail about the objectivity amendments. Those work very closely with the changes that I referred to previously relating to PES 4. So it relates to how to make sure that your engagement quality reviewer remains objective, and it also sets rules around time on and time off for that engagement quality reviewer. The piece I do want to draw your attention to relates to the fees and non-assurance services. So these are 2 key changes that work together to significantly strengthen the independence standards. And that's both from an independence in mind and an independence in appearance perspective. These changes come about because of global concerns out of many jurisdictions and have been brought largely by the regulator because of concerns around independence. So what these changes really aim to do is to strengthen and rebuild trust and confidence in audit, which is paramount to retaining trust and confidence in the financial statements themselves. These changes are packed with guidance to help auditors to consistently apply the conceptual framework to identify and evaluate threats to independence, make sure that everybody is effectively implementing these standards. These changes also result in clearer and more enforceable restrictions. So I'm going to talk about the non-assurance services changes, and then I will pass over to Sharon, who will deal with the changes resulting from fees. As I mentioned, and will remind you, these changes are effective from December 2022. So what has changed? If you audit any clients, so that's if you're auditing public interest entity clients or smaller clients, there are changes that will apply. The key changes relate to the prohibition on assuming management responsibility. So while this prohibition has existed in the past, it has now been clarified and moved separate from the prohibitions around non-assurance services. And this is to strengthen and enhance and clarify that the prohibition on assuming management responsibility applies to all aspects of the relationship between audit firm and client. And this not only relates to audit clients, it relates to review clients, as well as any assurance engagement that your firm undertakes for your clients. There is a prohibition on providing non-assurance services to all clients if those services create a threat that is not at an acceptable level and cannot be addressed by eliminating the circumstance or applying safeguards. So this is where that additional guidance to help auditors to understand, evaluate, identify threats. There's a lot more guidance throughout the non-assurance services section to help auditors to do this, as well as new material to highlight considerations when your firm might provide different or multiple non-assurance services to your clients and how these add up to create a higher level of threat and what to do in those circumstances. So that's to all audit, review and assurance engagements. But the big changes really come in if you are auditing what we talk about as PIEs. PIEs is our shortening for a public interest entity. So if you undertake audit or review engagements for any tier 1 entities, that is any audits that you undertake under the FMAs Act, or if you are doing large tier 1 entities that are in the public sector or large not-for-profit entities, as well as any other clients that have public accountability, then these changes are quite significant. What it really means is there is a new prohibition that is focused on a self-review threat. This prohibition is expected to bite and is expected to significantly reduce the amount of non-assurance services that an audit firm can provide to its audit clients. So what this prohibition means is that if it might create an independence threat in appearance or in mind, that's any possibility. So if there is a 1% chance that providing the service might create an independence threat to self-review, then it is prohibited. Materiality is no longer a consideration in determining whether that prohibition applies. There is a two-pronged test in determining what might create a self-review threat. And that relates to services that will form part of or affect accounting records, internal controls, or the financial statements themselves. And, that's an and, if the audit team will evaluate or rely on the judgments made from those activities that have been performed. So that's the guidance that will help firms to identify if a service might create a self-review threat. Two other aspects that I just wanted to highlight today. One is that firms may continue to provide advice and recommendations, provided they do not assume a management responsibility. And if they are providing that advice and recommendations, they must continue to apply the framework to identify, evaluate, and address threats to independence. The final piece of this puzzle is that the firms must also obtain concurrence of those charged with governance before it can provide any non-assurance service. So we expect, like I say, that these provisions will significantly reduce the amount of non-assurance services that are provided to public interest entities. To assist firms to understand these changes, there is some new implementation guidance that's only just been added to our website last week. The International Ethics Standards Board's staff have issued their frequently asked questions. So the link to that is also on our PES1 page. And we've also developed a staff cheat sheet. Why I'm calling it a cheat sheet, it's really just a summary of all of the different types of non-assurance services that the code deals with, and a summary of whether those are prohibited expressly or whether the conceptual framework approach applies for both PIs and non-PI clients. The big part of this project related to if and how New Zealand should adopt the international standard. So again, I want to thank you all for the comments and participation and feedback that you provided as we worked through if and how to change the international code for New Zealand. We have issued the New Zealand version of the standard. We have retained the approach of the self-review threat prohibition. And we did a lot of work relating to tax advisory and tax planning services. So let's just take a step back and remind you all about what the international position is. The AESPA recognised that in many instances, when providing tax advisory or planning services to an audit client, really what this is, it involves an application of established or accepted tax law and practice. And in the International Board's view, the advisory elements of such services that are not focused on an interpretation of the position, but really just an application of those provisions to the client's circumstances, they determined that this did not create a self-review threat. So the standard says that a firm is allowed to provide tax planning or advisory services where those services are supported by a tax authority, are based on an established practice that has not been challenged by the relevant tax authority, or have a basis in tax law that the firm is confident is likely to prevail. Now in New Zealand, PES1 is secondary legislation, and the NZAUASB determined that there is a compelling reason to clarify this confident is likely to prevail, given concerns that this might be interpreted in a subjective way. So the NZAUASB has added application material to clarify that a firm will need a very high level of confidence that the advice is likely to prevail. And they've also added a documentation requirement so that the firm must document the factors considered and the conclusions reached. More information about the New Zealand changes can be found in our Explanations for Decisions Made document. And again, that is available on the website under the PES 1 standard. So that's the changes that relate to the non-assurance services. I'm now going to pass over to Sharon, who will talk you through the fee aspects.
Thank you, Misha, and good afternoon, everyone. As Misha said, I am now going to take you through a few of the key revisions to the fee-related provisions of the code, and these are effective from December 2022. So some of the key features, there's the premise that there is an inherent self-interest threat created by the audit client payer model. There's some new guidance about the proportion of fees and what it means to be a large proportion. There are strengthened provisions in relation to fee dependence and for PI audit clients around the communications with those charged with governance. So the code recognises that the client payer model, that is where fees are negotiated with and paid by the audit client, create inherent threats to independence, particularly self-interest threats. The conceptual framework requires that before a firm or network firm accepts an audit or any other engagement for an audit client, the firm determines whether the threats to independence created by the fees proposed to the client are at an acceptable level. Sorry, Mish, you can just take it back to the previous slide. So how does the firm demonstrate its consideration of threats to independence, particularly around this inherent self-interest threat? A firm's system of quality management implemented in accordance with PES 3, and this is the new version that Misha has just spoken to you about, and operating effectively could contribute to the firm evaluating the level of threats as acceptable. For example, the policies or procedures within the firm's system of quality management might be designed to ensure that fees to be determined fully take into account adequate resources to perform an audit engagement. In this case, in complying with those policies and procedures, an engagement partner for the audit of a client's financial statements might conclude that the threats created by the audit fee paid by the audit client are at an acceptable level. On the other hand, those policies and procedures might require an analysis of threats and the application of safeguards in specific situations, such as when multiple non-assurance services are provided by a firm or a network firm to an audit client. In that case, through following the policies and procedures, an engagement partner might document the analysis of threats, any safeguards applied, and the conclusions reached. In fact, there is a new prohibition in the code which states that the firm shall not allow the audit fee to be influenced by the provision of services other than audit to an audit client by a firm or network firm. And that means a firm cannot charge a lower audit fee because it is able to charge significantly more fees for other services to the audit client. So let's now move on to the proportion of fees, and we can stay back at the other slide, please, Misha, from other services to the audit fee. And what's included when we say audit fee? What do we mean? The code does not establish a cap or a threshold regarding the proportion of fees for services other than audit to the audit fee. But in general, the larger the proportion, the higher the level of threat. Professional judgment and consideration of the facts and circumstances from the perspective of the reasonable and informed third party are necessary. And facts and circumstances might include, for example, whether the services other than audit are one-off or recurring, whether it is likely that the audit fee will increase significantly because of an imminent acquisition by the client, or whether the auditor is required by law or regulation to provide some services other than audit. So audit fees comprise fees or other types of remuneration for an audit or review of the financial statements. When determining the proportion of fees for services other than audit to the audit fee, the audit fee includes the fee for an audit of financial statements and any fee for a review of financial statements. Fees for audit-related services are not included in audit fees. Fees for services other than audit cover fees for any other professional services provided to the audit client, including any fees for audit-related services, and that is regardless of whether they are required by regulation or not. The audit fee is only the fee for any audit or review of the financial statements, and not the fee for any ancillary services. So if we can move now to the next slide, please, Misha. And take a look at fee dependency and what does it mean to be dependent. So when the total fees generated from an audit client by the firm expressing the audit opinion represent a large proportion of the total fees of that firm, the dependence on and concern about the potential loss of fees from audit and other services from that client impact the level of the self-interest threat and create an intimidation threat. So the slide showing now just provides for you a high-level overview of the requirements around fee dependency. The code establishes for non-PI audit clients that when fees from an audit client represent 30% of total fees received by the firm over 5 consecutive years, this creates a fee dependency situation. And for PI audit clients, it's when the fees from an audit client represent 15% of total fees received by the firm over 2 consecutive years. To reduce the threat to independence from fee dependency to an acceptable level, a pre-issuance review or a post-issuance review performed by an assurance practitioner outside the firm might be an appropriate safeguard. Under the drafting conventions for the code, the term firm does not include network firms, so the code permits the assurance practitioner outside the firm who performs the review to be a member of a network firm, providing the provisions of the code relevant to appropriate reviewers are met. Now, an appropriate reviewer is a professional with the necessary knowledge, skills, and experience and authority to review the relevant work performed in an objective manner. The code does not limit appropriate reviewers to individuals only within the firm, so your appropriate reviewer may be someone outside your firm. Now, the only appropriate safeguard to reduce the threats to independence of continuing fee dependency is a pre or a post issuance review performed by an objective reviewer outside the firm. If the firm concludes that such an action, so that is that a pre-issuance or post-issuance review would not be an appropriate safeguard, the firm would be required to cease being the auditor of the entity. Now, an engagement quality review in accordance with the new PES 3 and PES 4, so that's the quality management and engagement quality review standards, does not have the same objective as a pre-issuance review and would therefore not necessarily fulfill the code's requirement for a pre-issuance review in the case of fee dependency. Now, Misha, if you could move to the next slide, please. For PI audit clients, the communications with those charged with governance have been significantly enhanced. Firstly, the code requires communication of fee-related information to those charged with governance to be made in a timely manner. The code does not specify what timely means. The determination of timely is subjective and will depend on the nature of the information to be communicated and the circumstances of the engagement. For example, the nature of the services, whether one-off or recurring engagements, changes in scope or unforeseen issues arising during the engagement, governance arrangements of the audit client, and these are just to name a few. Firms will use professional judgment in determining the timing of the communication, but should be guided by the principles of timeliness. Where total fees for the audit client is more than 15% of fees received by the firm, communication is required with those charged with governance. Now, this is different to the fee dependency that I just spoke about. Fee dependency kicks in when fees from an audit client represent 15% of total fees received by the firm over 2 consecutive years. The communication with those charged with governance is required from year 1. The firm also needs to disclose any safeguard applied in the first year to address the threats created by the fee dependency. But note that again, the requirement for a pre-issuance review only kicks in when fees from an audit client represent 15% of total fees received by the firm over 2 consecutive years. Such a level of fee dependency on a PI audit client is essential information for those charged with governance to make an informed judgment about the firm's independence. The communication also provides an opportunity for those charged with governance to consider possible actions to reduce the level of fee dependency, which could include discontinuing other services provided by the firm and instead engaging other firms for these services. Next slide, please. So where can you find implementation support? So highlighted on your screen, you'll see a screenshot of the PES1 page of the XRB website. Highlighted in yellow there, you can see the IESPA staff FAQs that have recently been released, and these provide some really useful guidance. But of course, a reminder here that reading the Q&As is not a substitute for reading the code. Also, in relation to the transparency of fees paid to the entity's audit firm, the NZASB is currently consulting on proposals to improve the quality and consistency of disclosures of fees paid to the entity's audit firm, which you might find interesting. This consultation is open until 30 September. I'll now pass over to Tracy, who will provide some information on the new group audit standard. Thank you.
Thanks very much, Sharon, and good afternoon, everyone. Well, the XRB has recently approved a new group audit standard, ISA NZ 600 revised. The standard's official title is Special Considerations Audits of Group Financial Statements, including the work of component auditors. It is applicable for audits of group financial statements for periods beginning on or after 15 December 2023. And when it comes into effect, the new standard supersedes the existing ISA NZ 600. The changes made in the new standard flow from other recent IAASB revisions, such as the revisions to the quality management standards, and the design of the standard is such that there are separate sections for when component auditors are involved in the group audit. Because it is a new standard, the history of amendments table at the front of the standard currently has no details in it, but when future amendments are made to the standard, this table will then be updated. In the New Zealand context, many New Zealand firms are component auditors for overseas groups, and so the component auditor requirements will likely be of particular interest. So what outcomes is the new standard for group audits aiming to achieve? Well, there are 4 main outcomes that the IAASB is aiming to achieve with this new standard. These are proactive quality management, keeping the standard fit for purpose, a need for robust communication, and requiring a challenging and sceptical mindset of the group auditor. So let's look at these in a little more detail. In terms of quality management, the standard introduces a risk-based approach for planning and performing the group audit engagement. The standard acknowledges that component auditors can be, and often are, involved in all phases of the group audit. The standard also clarifies how the requirements of the New Zealand Auditing Standard on Quality Management, ISA NZ 220 revised, applies to manage and achieve quality in a group audit. This includes sufficient and appropriate resources to perform the engagement and the direction and supervision of the engagement team and review of its work. The standard also clarifies how the concepts of materiality and aggregation risk apply in a group audit. So let's just look a little deeper into quality management. The standard requires the group engagement partner to take overall responsibility for managing and achieving quality on the group audit engagement. He or she takes responsibility for creating an environment for the group audit engagement that emphasises the expected behaviour of team members. For example, the group engagement partner is required to make component auditors aware of the relevant ethical requirements that are applicable, and also to confirm whether component auditors will comply with the relevant ethical requirements, including those that relate to independence. The group engagement partner must also determine that component auditors have the appropriate competence and capabilities, including sufficient time to perform the assigned audit procedures at the component. He or she also takes responsibility for the nature, timing, and extent of direction and supervision of the component auditors and the review of their work. So overall, the group engagement partner is required to be sufficiently and appropriately involved throughout the group audit engagement, including with the work of component auditors, so that he or she has the basis for determining whether the significant judgments made and the conclusions reached are appropriate given the nature and circumstances of the group audit engagement. So, in terms of fit for purpose, group financial statements are defined broadly in the standard. In the standard, group financial statements are defined to include the financial information of more than one entity or business unit through a consolidation process. For the purposes of this standard, the term consolidation process includes the preparation of financial statements in accordance with an applicable financial reporting framework. For example, consolidation, proportionate consolidation, or the equity method of accounting. It also includes the presentation of combined financial statements of the financial information of entities or business units that have no parent but are under common control or common management. And finally, it includes the aggregation of the financial information of entities or business units such as branches or divisions. The group audit standard can also be adapted as necessary to situations other than a group audit, where the engagement team includes individuals from another firm, for example, a physical inventory count, an inspection of property, etc., at a shared service centre in a remote location. Also, in terms of fit for purpose, the new standard addresses linkages to other New Zealand ISAs. It also contains documentation requirements and application material emphasising the linkage to ISA NZ 230, which is the auditing standard on audit documentation. The standard also emphasises the importance of the group auditor's review of the component audited documentation and recognises that the review of the component audited documentation is directly related to the direction and supervision requirements. The audit documentation for the group audit engagement needs to be sufficient to enable an experienced auditor having no previous connection with the audit to understand the nature, timing, and extent of the audit procedures performed, the evidence obtained, and conclusions reached with respect to the significant matters arising during the audit. And the standard sets out in further detail the specifics as to what must be included in the documentation by the group auditor. In terms of robust communication, the standard strengthens and clarifies the importance of two-way communication between the group auditor and the component auditor. and also various aspects of the group ethical requirements, determining the competence and capabilities of the component auditor, and determining the appropriate nature, timing, and extent of involvement by the group auditor in the work of the component auditor. The group auditor is required to communicate with component auditors about their respective responsibilities and the group auditor's expectations, including an expectation that communication between the group auditor and component auditor will take place at appropriate times throughout the group audit. If we move next to professional skepticism, the engagement team is required to plan and perform the group audit engagement with professional skepticism and to exercise professional judgment. The standard emphasises the importance of professional skepticism, including as part of the group auditor's direction, supervision, and review of work, and the evaluation of whether sufficient appropriate audit evidence has been obtained, including by component auditors. The exercise of professional skepticism by the group auditor includes remaining alert for inconsistent information from component auditors, component management, and group management that may be significant to the group financial statements. Just in terms of scalability, because the standard uses a principles-based approach, it is adaptable to a wide variety of circumstances and scalable for audits of groups of different complexity, because it focuses on identifying, assessing, and responding to the risks of material misstatement of the group financial statements, and it includes separate sections throughout the standard to highlight the requirements and application material when component auditors are involved. For example, a group audit may be carried out entirely by the group auditor, in which case the component auditor requirements in the standard will not be relevant. This may be the case when the group auditor is able to perform the audit procedures centrally or is able to perform procedures at components without involving the component auditors. If you'd like to take a further look at the requirements of the new standard in more detail, the standard can be found on our website at the link on the slide. The IAASB has also produced a very useful fact sheet, and we have included a link for you on the slide to that as well. I'll now hand back over to Misha, who will take you through another recent approval, the deferral of NZAS1 relating to the audit of service performance information.
Great, thank you very much, Tracy. So yes, this is one of the final standards that we wanted to highlight today that has been issued and gazetted. It's a very small change. It's really just changing the mandatory effective date for 1 year. So NZAS1, the audit of service performance information, will not be required to be applied until periods beginning on or after 1 January 2023. Now, we've been getting some questions about why we're doing this work, and we are about to issue a sort of staff frequently asked questions document, but I'll give you a sneak peek of some of the questions that we've been asked and try to answer some of these questions today. The obvious one is, why did we defer the effective date? Well, the reason is that the Office of the Auditor General has raised concerns regarding the suitability of NZAS1 issued by the XRB for the public sector. So the standard has been deferred to allow us time to work together with the Office of the Auditor General to address these concerns. The next question that arises is, well, what standard must I use in the interim? Can I early adopt NZAS1, or what other standards should I use? So we know that some auditors have already adopted NZAS1. We are not withdrawing NZAS1 at this stage. And so, yes, you can continue to early adopt NZAS1 if you wish to. For those of you who are currently auditing service performance information using ISA E3000 or the guidance that's available on our website under EGAU9, you can also continue to use ISA E3000 and that guidance. And then, of course, if you are auditing in the public sector, you must remember that the Auditor General standards then apply, and they have AG4 in place. So we're in this situation where there's actually 3 possible standards that you could use to audit the service performance information. A key question which I really wanted to confirm and just reiterate today is, does the deferral of the auditing standards mandatory effective date impact the audit requirements of the entity? And the answer to that is an absolute no. So PBFRS 48 is the accounting standard which comes into effect this year for Tier 1 and Tier 2 entities. So those entities are required by that standard to report service performance information. And if those entities are required to have a statutory audit engagement, then the audit includes the service performance information. So the deferral of NZAS 1 does not defer the effective date of 48. It just means that in the interim period, as we work with the Office of the Auditor General, there are 3 possible standards that the auditors can use. I'm aware of time, and we're just on time to talk very briefly about what's coming. So most of this morning has been about those standards that are effective from December. That's quality management and the changes to the code. Tracy gave you an update on the groups, which is effective 1 year later. And I've just reminded you that the audit of service performance information, you've got extra time before you have to apply NZAS 1. Before we finalise, I just wanted to highlight to you some of the current consultation documents that we have open for consultation. The key one, which closes next week, is on the New Zealand definition of a public interest entity. Now, throughout our independence update today, you would have heard both myself and Sharon talking about pies. This exposure draft is all about who should be a public interest entity for the independence requirements in the Code of Ethics. Now, globally, the international position has an increasing and expanding public interest entity definition. It's actually catching up to where the XRB's PI definition has been for many years. So given those changing international requirements, the XRB is proposing to retain our existing New Zealand definition. As I mentioned previously, that is all those Tier 1 entities, those FMC reporting entities with higher level of public accountability, or those large public sector and large not-for-profit entities. If you have any concerns or evidence to support those concerns, we really encourage you to get in touch with either myself or Tracy. Tracy is leading that project, and we really are seeking feedback by the end of next week. So the submissions close 15th of August. Part of those international requirements also include a requirement for the audit firm to be transparent if they are applying the public interest entity ethical requirements. So to operationalize that transparency piece of work, the Auditing and Assurance Standards Board internationally is proposing that that disclosure be made in the audit report. So the first 2 exposure drafts up on the slide sort of work hand in hand together. They come in from different boards, and so the comment dates differ. But if you wanted to drop us an email or send us your comments around either the definition of a public interest entity or these proposals to disclose in the audit report if the audit firm is using the PI independence requirements, now is the time to have your say. So speak now or forever hold your peace. And then the third exposure draft that we have open at the moment is also a New Zealand specific standard dealing with assurance over financial information prepared in accordance with the capital raising. So this is a very, very narrow scope standard. It's very specific to sort of any of your clients that are undertaking an IPO. Some of these entities are voluntarily seeking an assurance engagement over that information. And there is no international standard that deals with this, but there is a standard in Australia. So we have heard concerns that from New Zealand practitioners that, there's a gap here and they're relying on the Australian standard. The Australian standard has a lot of relevant Australian legislation, but doesn't apply in the New Zealand context. So we've worked very closely to align our New Zealand version of the standard with the Australian, but to make it relevant for the New Zealand context. So if you do have any clients who are undertaking IPOs and you have been asked to perform assurance engagements over that information, please get in touch with Sharon. She's really keen to hear your thoughts and views about our proposal to develop a New Zealand specific standard in that space. And then to finalise, I thought I'd just give you an overview or flavour of some of the ongoing work of the Auditing and Assurance Standards Board, both domestically and then what's happening in the global context. So as you all know, the XRB is gearing up for the climate reporting regime. And under the Act, there is a requirement for the greenhouse gas emission disclosures to also be subject to assurance. We are working away furiously to develop an exposure draft for that specific limited scope mandatory assurance engagement. And we will be having a very crucial discussion at our NZAUASB meeting on Wednesday. So if you wish to sign up to observe that meeting, the papers are up on the website as well as we work to develop an exposure draft. We're hoping to issue the exposure draft towards the end of this year. In that space globally, there is a lot of work being done, which recognises this broadening scope of reporting to include climate reporting and other types of sustainability reporting. So both the International Auditing and Assurance Standards Board and the Ethics Standards Board have a significant focus on developing standards in this space. At the moment, we have Lynn Provo, the NZ IAASB board member chairing the task force, who is tasked with developing a standard for sustainability assurance. The direction of travel at this stage is to develop a separate standalone assurance standard, which will be separate from ISA E3000. The other question that's bubbling away from an ethics side is what should the independence requirements look like for these engagements over sustainability type of information, given that increasingly these engagements will be mandatory and will be under scrutiny from regulators. At the moment, the Part 4B of the code, which sort of sets out those independence requirements, is not really developed under that kind of context. So they're doing a fit for purpose review of those independence requirements. And then they're also looking at whether to open up the applicability and the scope of the code more broadly than just to professional accountants. And this recognises the broadening subject matter and subject matter expertise and sort of raises questions around, well, other assurance practitioners are also providing assurance here. We want to bring everybody together. So these are very similar challenges that we are looking at in terms of developing our exposure draft for the assurance on greenhouse gas in the first instance, but we're keeping a close eye on those developing requirements as we expect the assurance regime will also grow over time. So we've got some outreach events planned in September. So either sign up and come and observe the NZAUASB meeting on Wednesday, or please look out and come and join us for our outreach as we try to develop an exposure draft in that space. Also look out for a exposure draft on audit evidence. The IAASB is expected to approve that at their September meeting, and we will be undertaking some consultation on those proposals. That's really to modernise the audit evidence standard, recognising the changes in technology. We also expect an exposure draft for the audit requirements on going concern to be approved by the end of this year. So we will be undertaking some further consultation on that work as well. So those are the key ones out of the IAASB. As I mentioned, from an ethics perspective, we're kind of catching our breath over the fees and non-assurance services. There's been a raft of changes to the Code of Ethics. The IASB is currently very focused on that sustainability assurance piece, as well as expected to issue an exposure draft on tax. That's not so much within the mandate of XRB. It's not where an audit firm is conducting or providing tax services. This is really provisions that apply to tax practitioners. So if you have members in your firm who are just tax professionals, that exposure draft will be of interest to them, but it is largely beyond the mandate of the XRB, which is really focused on the assurance side of things. So that's a really quick tour of things to watch out for, what's coming. Before we conclude and wrap up, I'll just remind you that we are in this focus of trying to help people prepare and get ready to implement our standards. So as part of this Need to Know series, our accounting standards teammates will be having their Need to Know presentations. So one for the not-for-profits and one for for-profit entities, 16th or 17th of August. So if you're interested, please do sign up for the appropriate event. And then just to finish off, if you haven't already, please follow us on LinkedIn, sign up to our alerts and our updates, or contact us, drop us a line at assurance@xrb.govt.nz. So I know we only have 5 minutes left before we end. If anyone does have any questions, we might be able to answer 1 or 2 of those before we close. So it's an opportunity for you now to put any questions you have in the chat. Otherwise, drop us an email and we'll try and respond to those questions. Don't see any. Not sure. I'm not very good at seeing the chat. I don't know if you can see any questions or anything, Tracy or Sharon. Don't think so. Right, well then without further ado, I would like to really thank you all very much for your attendance today. As I mentioned, we will be sending out a survey and we would appreciate it if you could spend 2 minutes and just give us some feedback. We hope that this has been a useful session for you so that you feel better prepared, understand what's coming and where to go to find some implementation support. So without further ado, we'll close this and say thank you very much.